Hey YouTube, Simon Dixon here. Somebody left a comment saying that I shouldn't refer to our community as YouTubers. And you know what? They're right. Let me know what you think we should call our community so that I can introduce you all and reach you more people that want to change the future of finance and want to build and protect their wealth. Love to hear your comments in there, because today we're going to be talking about a very important subject, which is the fact that the Federal Reserve has approved the increase in interest rates to a range between 0.25% and 0.5%, when at the moment, or prior to this, it was nearly 0%, and in some countries like Europe, negative, and various other sorts of things. What we're going to be doing today is we're going to be discussing what does it mean for you and the monetary system. So the first thing I want to discuss is how detached our debt-based monetary system has moved us from reality and humankind. And so look at the ethics and the actual real life impact of these things. So if you think about it, the rules of a debt-based monetary system is that the government have outsourced the ability to create money. The way they do that is they give banks the ability to create a digital currency. It's a digital representation of the currency that the government creates, which is cash and coins. And then the central banks also create their own version through quantitative easing, which is where it fires up some digital currency and it uses it to purchase some bonds, which is a loan to the government, as it were. And so you've got these different forms of money. Cash and coins created by a treasury. When you print a $10 note, it costs about 3 cents to create, and $9.97 goes to the treasury in seigniorage income, and it reduces the amount of tax one needs to pay. The digital currency created at a bank is a digital representation of the dollar, the pound, the euro, the yuan, the yen. And it represents somebody else's debt. So it's created every time you take on a student loan, fire up a credit card, go into your overdraft, or take on a mortgage or any other type of loan. Quantitative easing is just another beast. Now, what does interest rates mean? So the Fed, the central bank, sets an interest rate, and that interest rate performs a number of things, but in a nutshell, without going into the geek, it is a benchmark interest rates that banks use to lend to each other, and financial products use as a base rate in constructing their financial products like mortgages and various other things. It has an impact in all different types of markets, and in a debt-based monetary system, remember the rules of money. The rules of money are as follows. If you want to have more money, you have to have more debt. If you want to have less debt, then you have to have less money. And I use the word money because it's what people understand, but really it should be distinguishing between currency, which is what these banks and governments create, and it's designed to go down in value because it's operating off a Ponzi scheme and they always have to create more in order to pay off the old debt. And money, which is something that cannot be changed, its supply, so it acts more as a store of value. An example is money that comes from the ground gold, and money that comes from a blockchain and a supercomputer that cannot be changed, i.e. Bitcoin, digital hard sound money. And so with that distinction aside, I use the word money and currency interchangeably, but just an aside. In a debt-based monetary system, you have to have more debt in order to have more money. So think about what interest rates does. So when you push down interest rates, you are essentially saying, please borrow some more money. We need to create more money. We need banks to lend more. We need more mortgages. We need more student loans. We need more credit cards. We need more overdrafts. And we need to stimulate the economy through more money creation. So let's reduce interest rates, and then we can stimulate the economy. And then when that comes through and people borrow more and more debt takes on, more money gets created into the system. And as more money is created into the system, it can flood the market to a certain point. So it takes a business cycle goes up, and then what happens is this bogey called inflation comes along. In the US, it was reported consumer price index of about 7.9% at the moment. The goal is meant to be 2% consistent inflation, and the producer price index is about 10%. And if you take inflation by the old measures, it's over 10% and above. So you could say that this is a inflation disaster. At the same time, we've got a contracting employment and economy, and therefore you have what's known as stagflation, where you have inflation plus declining growth based upon various events and geopolitics that is happening in the world right now. Okay, so we create a new business cycle. This bogey called inflation comes along, and what do we need to do in order to control inflation? Well, we reduce interest rates. Why do we reduce interest rates? Sorry. We increase interest rates, even confusing myself. When we increase interest rates, what do? We're essentially saying to the people that, right, this inflation, there is too much money, we need to contract the money supply. How do you contract the money supply? Well, it can happen in a few ways. Either you pay off more of your debt, and if they increase interest rates, what's the likelihood of you being able to pay off your debt faster? Well, logic would say that more of your money goes towards paying interest, and therefore you're less likely to pay off the debt faster, because when you repay a loan, the money supply contracts because it was created by a bank as debt, and that debt disappears. The magic of how this happens is if you look at a bank's balance sheet, and don't worry, this is too geeky for you, you have assets and you have liabilities. Every single time you borrow money, they create an asset. It's an asset because you owe the money, and a liability because they create a new balance on your account, which is new money that you can draw upon, and therefore they owe it to you. So it's double bookkeeping, as it were, is the magic of how this happens. And so when you pay it off, that contracts the money supply. Or you go bankrupt. And so if you go bankrupt because the interest rate has gone up, then it crashes, it leads to a contraction in the money supply in order to try and control inflation. So let's just look at the ethics or just the construction of a debt-based fiat Ponzi scheme. In order to have more money, you have to have more debt. In order to have less debt, you have to have less money. So in order to grow an economy, you have to have more debt. So in order to have more debt, we put interest rates down, and we encourage people to save the economy by borrow. Both companies borrow, individuals borrow, governments borrow, central banks borrow. We increase the money supply. Magic. So we save the economy. Well done to you. Everybody that took on debt, you're the hero of the economy. You saved the economy. You've led us into an economic growth cycle. Oh no, but this boogie monster called inflation's now come along. We better do something. What are we going to do? We're going to send the people that saved the economy bankrupt by putting up interest rates so they can no longer afford their mortgages. Now, the rich people that have lots of reserves and lots of assets or invested it in assets may be able to survive the interest rate hike. But those that were on the breadline, that we put all sorts of government initiatives out there in order to encourage them to borrow more, you know, whether it be the subprime crisis or whether it be fixing the financial crisis with more stimulus of debt, encouraging people to take on more mortgages, then the same people that save the economy go bankrupt and save the economy again at the expense of their own personal life. And that is the reality of a debt-based monetary system. Now, I have no problem with debt per se. I have a problem with money created as debt and outsourcing the ability to create money to the private banking sector and then manipulating interest rates in order to drive business cycles and get people to take on more debt to save the economy and create the money, and then sending them bankrupt by increasing interest rates in order to send them bankrupt so that they can save the economy again in this business cycle of a debt-based Ponzi scheme that is now regulated and enforced by law. And so that is what happens when interest rates increase. Now, am I saying do not put up interest rates. That's absolutely what you need to do to control inflation in a debt-based Ponzi scheme. So of course, taking on more debt and perpetuating a Ponzi scheme by putting interest rates lower and encouraging everybody to take on more debt to pay off the old debt and keep the Ponzi scheme alive is not a viable solution. So of course, in free markets, we've got the world addicted to this drug called debt, and it wasn't debt based upon wealth or money created or collateral. It was debt based upon debt and created by a bank in the monetary system. Then increasing interest rates is the only free market solution that you can do to control inflation in such an environment. Now, my fear is what comes next is that as you increase interest rates more, the Federal Reserve has committed to 6 different hikes. As you increase interest rates more, yes, you try and get ahead of inflation, but you can end up in a stagflationary cycle. Even though we got all this technology pushing down the prices, we have these commodity crisis, geopolitical crisis, and all of that money that the time preference delayed the impact of, and the huge increase in money supply that is still going to cause large inflation, continue large inflation, and then as you put up interest rates, you get some of the economic decline that comes from people either going bankrupt or deciding to repay their loans, depending on how they structured their debt and how close they are to the poverty line based upon their disposable income that they have, and whether they've been following much of the content that I've been sharing with on this YouTube channel on how to build and protect your wealth and ensure that you are on the right side of financial history. So that's what interest rate means. I forecast, where does this go? If interest rates go up too high, which they absolutely have to in order to control inflation, you end up with stagflation, which exposes the weaknesses of the leverage in the financial system. That can lead to a financial crisis, 2007 and 8 style event, depending on the rate at which it does and the products that it exposes. Some systemic black swan event that we can't even think about right now. Last time it was this little Iceland where triggered off the whole thing, even though it was reported as just subprime, but the big exposure in investment banking happened in Iceland. Then you end up in a scenario where you have to reform the financial system. I don't think we will have bailouts. I don't think the appetite to bail in will be there. And so central banks or governments will have a fiscal and monetary union where they allow banks to go bust. They replace your deposits with central bank digital currencies. And then there's markets to auction off all the debt and leverage in the system. It moves to a deleveraging through central bank digital currencies. And this then leads to a real radical fiscal and monetary union that leads to less privacies, less freedoms, automated negative interest rates, automated central banking through connecting how you spend your money with their fiscal policies, and just a more and more tyrannical a control-led way of organizing an economy, which is why it's important to get as much Bitcoin adoption. Now that Bitcoin is in everybody's pension through ETFs, now that 14% of Americans, as it was done in the report on the future of money, own Bitcoin and cryptocurrencies, now that 10% of Koreans and politicians are dictating their policies, now that we have countries that have Bitcoin as legal tender, now that we have public companies that hold it on their balance sheets like Tesla, MicroStrategy and various others, now we have individuals that are betting their future on digital hard sound money, companies that are betting their future on digital hard sound money, and countries and central banks that haven't necessarily announced it, but have been implementing mining policies and legalizations like we're seeing in Ukraine right now, that is raising hundreds of millions in cryptocurrency in order to implement their programs or whatever they're doing right now. Then you have this adoption into this Bitcoin that makes this boogie monster band that everybody uses as a reason not to buy less and less likely as we progress. And it is because it is the world's largest supercomputer powered by proof of work. It means that nobody can shut it down, nobody can take it down. You can make it hard to use, you can regulate exchanges, but it's still the world's largest supercomputer that has ever existed, and our world's best shot at ever achieving digital hard sound money, performing the task of regulating central bank digital currencies so that if they get too far out of whack and check of what society wants, they have an exit and an opportunity to enter geopolitically neutral money you can own, money you can spend, and money that has a fixed supply. So it all ends up in that direction. My lifetime mission is to create as much content that supports people in building and protecting their wealth before it's too late. I wrote the book, Bank to the Future, Protect Your Future Before Governments Go Bust, over 11 years ago. And those that implemented it are in a completely radically different financial position today than they were when it was written. It was the first published book in the world to include Bitcoin. And if you want to get ahead of the curve rather than wait for disaster, then head over to retirementplanb.com/book. You can get a free copy of that book. You can get a 4-part video series on building and protecting your wealth. You can get a longer, completely free masterclass over 12 hours on that subject. And you can get all my emergency broadcasts, and I'll complete more emergency broadcasts as the debt-based Ponzi scheme unfolds. So always remember, you are alive at one of the most interesting and exciting times in financial history. Some are going to get hurt, some are going to do really well. Subscribe to this channel, hit the bell symbol, hit all, hit like, share with others, and I'll make sure that you're on the right side of this change. We're doing it with peace, we're doing it with love, we're doing it with unity. Peace.